Welcome to the Value Investor. This channel is about investing. I will talk about the stock market, I'll talk about personal finances, I'll talk about things like debt, credit cards, and things like that. The main focus will be on the stock market and investing. How do legendary investors like Warren Buffett and Charlie Munger, Peter Lynch, Joel Greenblatt, how do they make their money? The secret sauce is value investing. And in this video, I'm going to explain in simple terms what that is and how you can also do it as a retail investor. So stay tuned and watch until the end. So value investing, it means buying stocks for less than they're worth. It's not that complicated, but people make it complicated because they go in with emotions. They go in without doing the proper preparation. So the reason why I've said emotion is because emotions do play a very big part in investing. If you buy a stock, for example, you buy a stock at $100 or £100, depending on where you are, and then the stock market goes down a couple of points, and that investment is now worth 80. A lot of people will panic. They'll think, oh, the market is going into bear territory and I might lose, it might go down even further and will stay down for a couple of years. So they quickly sell out. So you bought something for £100, you're selling out for 80. That's buy high, sell low. Secret for disaster. That is not value investing. So value investing is you do your research, you identify that the true value of a company is say $200. You buy it at 100. It drops to 80, you keep holding, you actually buy more and you wait. It's a waiting game, patience. That's what this game is. And this is how money is transferred. It's transferred from the impatient to the patient. And that ingredient in between is time. And time is what you need in the market. You don't need to time the market. So that's value investing in a nutshell. It's you're not just buying a share or a ticker, you're buying a business. So Monish Pabrai, one of my favorite investors, he says, if you're not ready to buy the whole business at the price you bought that share, then don't buy it. And this rings true because once you think like that, you begin to think the way smart money does. So Warren Buffett also says price is what you pay and value is what you get. So consider two houses that are for sale. These houses, one is going for 100,000, but its actual worth is 200,000. That's the value. That's 200,000. So if you pay 100,000 for that house, what you're actually getting is 200,000. You're actually getting a value of 200,000. And then there's another house, house B. It's selling for 100,000, but it's all beaten up, it's all dirty, cracks everywhere, foundation is not sure. The house is selling for 100,000, but its actual worth is probably 60 grand. You will be paying 100 grand for something that's actually worth 60, and that's bad business. You want to be buying $1 using 50 cents. That's what value investing is all about. You're buying $1 using 50 cents or even less. The less the better. So why does value investing works? Now, from what I've already said, you've seen that smart money buys things for less and sells them for more. And this is basic business. If you're into the wholesale business, the retail business, you have to buy something for less and sell it for more. You add value, you sell it for more. That's what business is all about. And value investing is no different. But what you're doing is you're identifying companies instead of products or cars or houses. You're identifying companies that will do well in the future. So the reason why value investing works is because the market, Benjamin Graham calls it Mr. Market. Mr. Market constantly misprices assets. Benjamin Graham describes Mr. Market as someone who is very emotional, someone who is very neurotic, so he's got good days and bad days. On the good days, he will be selling things for way more than they're worth. He'll be on top of the world. And when this happens, things are going for like double, three times, your Teslas going for way, way more than they're worth. PEs will be like at 200 times earnings. And if you are an active buyer in this market, the chances are you will lose, because bargains, although they're there, you can find them here and there, but they're very rare. This happens normally when the market is in bull territory. There's been a bull market for a couple of years, and you're probably in your fourth, fifth, sixth year of a bull market. This is when the market is happy, and when the market is down, the market is in the dumps. Things are selling for way less than they're actually worth. This is the time that a value investor gets really excited. You're actually rubbing your hands and tapping your feet, and when everyone is out there complaining, crying, you're out there looking for those bargains that you have put on your watch list. And this is what I do. I've got a spreadsheet which tells me to buy when a price goes below my margin of safety. So the key principles in value investing, you've got what is called the intrinsic value. This is what actually a company is worth, and we calculate it in different ways. You've got the dividend discount, where we use dividends to calculate how much a company is worth, or you can use cash flow. So cash flow, you are basically just using that cash to estimate how much the company is worth. So you pull them out into the future and then discount them using a discount rate to the present. So that intrinsic value is a guide which shows you how much you must be willing to pay for a certain share. But there's also something called a margin of safety. So a margin of safety, you are now looking at this question: what if I'm wrong? And as a value investor, you always ask yourself that question. So if a company's intrinsic value is, say, $100, you would want a 30% margin of safety. I know different investors use different margin of safeties, but Benjamin Graham usually went with 30%. I go with 30%, but the bigger the better. And then you say, okay, what is 30%? So that's 30% is $30. So your margin of safety, you will only buy that $100 share when it goes below $70. So your margin of safety is 30%. So if you are wrong, that share can go down further than 70, but it won't go way down. So imagine if you had bought something for twice than what it's actually worth. You had bought that same share, that same $100 share for 200. If it goes down to 100, it can still go down even more, because the market on its bad days will sell a $100 share for 50. That has happened a lot in the past. So that's margin of safety. And then if you are a value investor, there's need for that long-term thinking, because a lot of these investments, they start to really compound after a decade. That's when the real compounding starts. And then you have to understand the business. You have to build what's known as a circle of competence in the businesses that you invest in. For example, personally, I've got a circle of competence in insurance companies. I like them. I love them. What's not to love? They're good. They're cash generative, and their models, they don't have a lot of fixed costs like your manufacturing companies. So I like them for that, and oil companies as well. Trying to build a circle of competence in that. So you need to buy things you understand, and once you do that, you'll be able to make decisions faster. You are more likely to notice if that company is going down, because you know the telltale signs. So the people who have inspired value investing would be your Benjamin Graham. I've talked about that. Peter Lynch, Philip Fisher, got a very good book. So the final takeaway is you have to buy things for less than they're worth, and you have to be patient. So if you've enjoyed this video, please, share it with your friends, your grandma, your auntie, uncle, who is trying to reach financial independence. And this is the other thing I'm trying to do as well, is to reach financial independence. I'm in a program called FIRE, Financial Independence Retire Early, and I'm trying to use the stock market to reach that point within the next 8 to 10 years. So if you've got someone who is like that, share this video with them. Let's invest together. Let's like, share, subscribe, and thank you for watching. If you've reached this far, thanks a lot, and subscribe. Cheers. See you in the next one.